For bond investors in 2022, it felt a little bit like riding a seesaw with an 800-pound gorilla. They were never in charge of the ride. It was going up and down at a really fast clip. In 2022, bonds in the US, the aggregate market, dropped the most that it ever had in history. And so today we want to talk a little bit about the factors that influence bond returns.
You know, as bond investors, we primarily need to remember that we're lenders. Whether we're lending to a government or to a company, we are lenders. And so we expect to be paid back the loan with interest. But bonds kind of, you can look at it and there's several different factors about why certain companies or certain governments will pay a higher or lesser interest rate. And so today we want to look at the factors that influence that interest rate and the price of bonds over time. And like you mentioned in the intro, Spencer, 2022 was a rough year for bond investors, and we'll kind of look into that a little bit. But if you need a refresher on bond investments, you can take a look at our videos, an overview of fixed income and equity securities, or considerations of risks when investing. And we'll link those in the descriptions below. But, Spencer, when we think about equity investments, they have factors, and there's a lot of them. Bonds have factors as well. Today, we're just going to consider term, credit quality, and liquidity. Anything we need to know just as we start off?
The first thing that we want to address is the inverse relationship between bond prices on the one side and interest rates on the other side. So in 2022, interest rates rose, and in that seesaw analogy, bond prices dropped. Now, if we think back the last number of years, we've been talking in 2022 about that 800-pound gorilla that we didn't have control over as bond prices were pushed down in that seesaw effect. But really, we've had a gorilla twice the size the last few years, a 1,600-pound gorilla, King Kong of sorts, in the Federal Reserve. And the Federal Reserve essentially was pushing interest rates down, which was pushing bond prices up. So printing a lot of money, and so as interest rates dropped, again, those bond prices were moving up. Well, the 1,600-pound gorilla, King Kong, got distracted, maybe not even distracted, disinterested, just decided to step off the seesaw. So the opposite side took over. Yeah. And that's what we really saw in 2022.
Right. We got a little example for that. So we're going to take this hypothetical example of birthday gifts for our wives.
Oh, wow.
So in March of 2020, I thought, hey, this is a great time. We're going to buy Kayla a 30-year treasury. The 30-year treasury.
Now hold on. To be clear, this isn't real Austin.
No.
This is hypothetical Austin?
This is bad decision hypothetical Austin.
Man, good.
Yeah. So, but the treasury, the interest rate was whopping 0.99%. So you, on the other hand, look at Emily and say, oh, I love my wife and I want to buy her a treasury. You do it, though, in October of 2022 when interest rates were 4.4%. So I got distracted with the 1,600-pound King Kong who was on my side pushing prices up. So I was like, this is a great time to buy. I made a bad choice. You, on the other hand, saw that the 800-pound gorilla had flown the interest rates up and you were going to get paid well.
Okay.
But on the flip side, what's happening is that if Kayla's treasury was $1,000, it's only going to be paying her $9.90 annually. Emily's treasury, on the other hand, is going to be paying her $44 for that same $1,000 investment. And so if they wanted to trade bonds, Kayla would know that Emily would be sacrificing $34.10 to take over to trade the bonds equally. And so there's a little bit of price adjustment because Kayla's held hers for 2.5 years, but let's just say that that's all equal. Kayla would have to pay Emily about $540 to make sure that Emily was whole because of that loss of annual interest payment.
So if you're keeping track of this at home, that's a loss of basically half of the value of the bond there because of those interest rate movements in 2.5 years.
Yeah, in 2.5 years. And you think about it, if that 30-year treasury was paying 0.99% and it shoots up to 4.4%, that's the low to the high across that time period. That's a really big movement in interest rates. It's 3.5%. I mean, that's a big movement in interest rate. So it's going to be a big shock to the system, especially if you're on that long end of that seesaw. So if we look inversely on that seesaw, instead of being out 30 years where that movement with that gorilla is really big, if you're in closer to the middle, that movement isn't going to be as substantial. If I bought Kayla a 30-day Treasury bill in March, well, yeah, interest rates were still low in April and in May, but as they started rising, then my bonds would have turned over every month, and we would have been able to start realizing some of that increase of interest rates that we saw in 2022. So that's where bond investors really need to be aware of the term of their bond investments. It's really crucial to know where interest rates are and then where they are on that seesaw for that volatility.
Because at the end of the day, we need to recognize that longer term bonds generally pay us a higher rate in most environments where the economy is kind of puttering along or doing better because we're at risk for a longer period of time. There are circumstances where that can be flipped, it can be inverse, but that's usually when we're heading towards recession or something like that.
All right, so Spencer, we've just talked about term. We're going to talk about credit quality next. And when we think about the highest credit quality, we typically think the US government. But there's a lot of different places that bond investors can invest and a lot of different credit quality that we can pursue higher rates of return. Why don't you explore credit quality a little bit for us?
Well, if you look at any kind of financial planning or investment textbook, it's going to say that the US government is the risk-free rate of return. There's not any company that's out there that can go down in the basement and fire up the printing press and pay off their debts. The US government can do so. We have our own currency there. So we have that unique capability to be able to mitigate risk, I guess you could say. If we think about generally lending, if we lend, whether it's a person or an institution, government, money, one of the things in the back of our minds is that we've got to bear is, are we going to get our money back? Because we're typically lending, say we lend $10,000, we're going to get paid interest through the term of that loan, and then at the end, we get paid back our principal. So it's really important that we get paid back our principal.
Yeah.
So the credit quality, though, is this analysis to say how likely are we to get the payments through the term of the loan, but then also at the end that we get the principal back. If we think about a couple of different companies, let's say company ABC is very, very strong, very good product line, a lot of cash on hand, run very well. We might not require a whole lot more interest to be paid if we're lending them money than say we lend to the US government. So let's say the government, we can get a 10-year treasury at this particular time for 4%, and this company we're lending to, we're requiring them to pay us 4.5%. We think that the potential for default, for them to go under or have issues with their credit are almost nil over the term of the next 10 years, let's just say. Maybe we factor in a default rate of something like 0.1%, but we are getting 0.5% more. So it works out well for us, maybe relative to US Treasuries. If we think about a different company, and let's call this company DEF, then that company, perhaps their product line is not quite as strong. They don't have quite as much cash on hand. They don't have quite the brand. Let's say that we think that the rate of default might be probabilistically 3%. We might require that they pay us 10% on an annual basis every year because we're taking on some default risk there. There are certain outcomes of the direction of this company where maybe 1 in 30, 1 in 40 times they're going to go under over the next 10 years. So we're pricing that in. As we do that, what we have to recognize is that increase in interest rate actually probably needs to be far above and beyond the default rate because we're taking on more risk. The ride is going to be more volatile typically because if we have a slowdown related to the economy, then those bonds are going to move up and down in value accordingly. So if we rolled things back to 2007, let's just say, and we're right on the cusp of the global financial crisis, we don't know it, and that company goes into difficult times, then a year later, their bonds might only be trading for 80 cents on the dollar. So that $10,000 investment, now I can only get $8,000 if I try to trade it because people are very concerned about a default risk.
Well, it's kind of like I think about different people I could lend to. I'm not going to lend somebody on the street the same amount of money that I would maybe lend you or my parents. People that I trust, I'm going to be a little bit more willing to take lower interest because I trust that you're going to pay me back. Whereas some random person. But again, if it's somebody that I'm not as well accustomed with or well acquainted with, if it's just a neighbor that says, hey, I need $20, can you pay me back? I'm not going to be as trusting that I will get my money back.
Right.
And so that's kind of what we think about in credit quality. If I know you, if I know that there is trustworthiness behind what you're doing, then you're not going to need to pay me as much. But if I don't know you that well, you really I need some more interest, more skin in the game to be able to be willing to make that loan.
Right.
So finally, we're going to talk about liquidity.
We want to think about the purpose of bonds, and that is generally to have a less volatile ride than stocks, give us some consistent income, and if we need to sell those bonds for purchases or things that might come up unexpectedly even. As we think about these different factors, this last one in terms of the liquidity is an important consideration because it just basically means that we can't get to the bond as easily or the fixed income as easily. If we think about an illiquid bond, we might be loaning to an individual or to a company or to some kind of circumstance where, since it's not publicly traded, we can't access those funds nearly as easily. If we lend to Apple or to the US government, we can go to a bond market that opens 5 days a week, and we can trade that with someone else because they know that Apple and the US government have certain characteristics, and there's certain ways that those bonds are set up. The language, the legal language, makes it easy to trade. If we instead make a loan to a private company that might be smaller, then we don't have that same capacity to trade in the publicly traded market. Now, the good news on the other side of things, though, is oftentimes if we're lending to a company like that, or even to an individual, the interest rate is higher, and the credit quality may not be much different. So if the interest rate is higher, and let's say we know that that particular part of our fixed income we're not going to touch for the next couple of years, that illiquidity may not be a big driver for us. We might like the fact that instead of, again, in that last example, company DEF paying us 10%, well, if we could lend to a company that had similar credit characteristics, but we just knew that we weren't going to be able to access the funds over the next quarter or year, or maybe we have a limited level of liquidity, if they pay us another 2 or 3%, maybe that starts to sound attractive because there are some investments that we want to have very liquid, primary reserve, other things that we can take withdrawals from. But if we have a portion of our investments that are relatively illiquid or have some barriers to get to them on a day-to-day basis at least, that can actually be nice for a portfolio if we're compensated for that illiquidity element. And typically that does happen. So it might be 2 or 3% more that an interest rate would be paid to us to make those illiquid investments.
And as we think about this kind of overall, when you think about, like you were saying, okay, primary reserve needs to be very liquid. We have to always come back to what are the risks that we're willing to take on. And if we need the funds, then we don't want to put it in these higher risk investments unless we have liquidity and unless we have the risk tolerance to be able to say, hey, I've got all that I need for the next X amount of months and I'm comfortable with that, or the next X amount of years. And so in all of these circumstances, we really need to factor in what is that risk tolerance that I'm willing to take? Because you can be risky with bonds, like we've seen. You can go very illiquid or high or low credit quality or long duration or short term. But you just have to know, what is my goal? What am I going for with this investment? And if I don't know that, it's really hard to determine that for a client. So that's why we really work hard with our clients to say, hey, what is your goal with this investment? What are you hoping to do with it? And then we start matching their goals with those investments that they want to make. But that's really the first place that we need to start.
We hope that this discussion of bonds, fixed income, their factors, how we think about rates of return has been helpful. As always, if you have any questions, don't hesitate to reach out to us. And in the meantime, take care.
If you like these financial planning videos, please share it with a friend. And if you have questions, go to our website at SeriousRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SeriousRetirement.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.